Back with Market Edge, and before the break, we told you what this segment is going to focus on. So let's just jump straight to the conversation. We've got Mr. Prabal Sen, the VP of Equity Research at ICICI Securities, joining us on the show. Prabal, hi, good to be speaking with you. You know, oil and gas, such a happening sector right now because we've seen such volatile swings given everything that was happening on the geopolitical front. Now that we're hearing some resolution, we're hoping that the discussions and peace talks, they hold on going ahead as well. What would you look at when it comes to oil and gas in terms of some levels that you're pegging in? And just give us your outlook on where do you think oil is headed in the near future? And largely, if you believe the market has already priced in all the volatility that we were supposed to see so far.
To answer your first question in terms of what levels crude could see, I think it really depends on what kind of financial positions are being unwound still. Difficult to peg a number in terms of what kind of shorts are being unwound or have been unwound over the last three sessions since the deal was actually announced. But very clearly, I think the trend seems to be downward. Our sense really is that once the frenzy or some sort of stability is reached in terms of the deal actually coming through or the negotiations seemingly progressing, crude can then start to show some moderation in terms of volatility. We still believe that based on every report that we read, that full normalization of shipping flows and full retreat of the kind of risk premium that's got built into insurance and freight, in the crude markets will probably still take a little bit of time to play through. And therefore, we don't expect a return to pre-conflict levels of below $70, or at least even if it does, we don't expect it to stay there. Our sense really is that while crude will moderate, you would probably see a band of $75 to $80 as a reasonable level in till the time the 60-day period goes away and a final deal is actually signed. And then we basically start to assess how much flows and how quickly the straight flows are back to pre-conflict levels. So I think there's a little bit of excitement that's probably baked in already in terms of numbers, particularly crude prices. And we believe that some correction upwards can actually still happen as we progress on this deal, because there is still a lot of uncertainty around what the final deal would take. There are players who are excluded from the MOU negotiations who have constantly said that they do not believe they're part of this peace agreement and they don't feel obligated to even sort of honor the ceasefire. So right. Difficult to sort of draw a conclusive answer on where crude will end up.
Right. Prabal, therefore, so given this uncertainty and maybe we'll end up in around $75 to $85, how much of this positivity has been built into stock prices, especially where OMCs and maybe some of the upstream companies are concerned as well? Give us a sense of that. Where do we stand at in terms of valuations? How much of that re-rating is played out? How much is pending?
No, I think in OMCs, I think there is probably still a little bit of, in fact, I think the re-rating is something that will continue to build. We have seen that, retail margins in the last couple of weeks, or at least over the last 3 to 4 days, have swung back into, let's say, break-even territory. Depending on what prices you assume, they are probably even making some element of positive margins as well. And I think that is not something that's fully baked in the stock prices at this point of time. Our sense really is that 1Q numbers will still be probably disappointing. You could probably see some pushback or some cutback in the prices. Post that, again, assuming that the deal continues to progress the way it is going, you can probably see a significant turnaround in the earnings performance of the OMCs over the rest of the year. And I think that upgrade will bring with it its own momentum in the stocks. As far as upstream is concerned, in fact, upstream has actually reacted negatively. If you really look at the last 1 month performance, the expectation of a deal being struck and the softness in crude probably has reversed a little bit of gains, specifically in Oil India, from what one can see. So as and when clarity emerges on what is the bare minimum, what is the base of crude prices, one can probably then start to draw conclusions of where FY27 earnings would look like. One thing that I would like to highlight is the softer and the more positive expectations get baked into crude prices. The chances of any sort of windfall taxes or any sort of measures to curtail oil company upstream realizations will basically recede. And that means that FY27 earnings can actually still see upgrades as far as we are concerned. So that's something to look forward to.
That sounds positive. Prabal, while that is on the entire OMC front, I want to shift the focus of this conversation and talk about gas stocks. IGL, MGL, Gujarat Gas. Give us a sense of which one of these has most sensitivity to fluctuation in gas prices, and how would FY27 shape up for these names?
So I think the very simple sensitivity that I can give you is that every $1 change in weighted average gas costs for each of these companies has an impact of around 2 to 3.5 rupees per SCM in terms of their per unit EBITDA, which is a significant number when you consider that the base case itself, and I can only speak for myself, our base case is basically anywhere between 5.5 to 6.2, 6.3 rupees an SCM for the three companies. So to that extent, obviously, any reduction or moderation in LNG prices, or which leads to a lower weighted average cost of gas for these companies, I think will be extremely positive from a margin perspective. Having said that, I think for Gujarat Gas or Gujarat Energy, the situation can turn slightly tricky if propane availability once again starts to really pick up. Because if you remember, the entire momentum in Morbi volumes has come about because LPG volumes have been basically completely eliminated from that market. And whatever has been available at an extremely high price, with LPG prices in Asia going to $900 a ton and above. A moderation in those prices because of availability once again brings gas on an even keel or at a premium to LPG prices. I mean, to give an example, if LPG prices were to come back or settle in at $650 a ton, the rupees equivalent price would be closer to 52, 53 rupees, whereas the price being charged by Gujarat Energy today in the Morbi region is close to 77 rupees an SCM. So there, one will have to see what the equation is between volumes and margins. For IGL and MGL, really gas availability would improve margins.
Prabal, I have just 30 seconds. City gas distributors, are they at an interesting inflection point? Because now you want to diversify energy sources, right?
Yeah, as I said, I mean, I think the new regulations that came through in this crisis by the government, which have made it easier and have created time-bound, conditions for approval of ROUs and final level permissions for connectivity of customers in the CGD networks, that is bound to provide momentum in terms of higher penetration. And as you rightly mentioned, the more we sort of diversify or the more we improve penetration of natural gas, specifically in domestic and transport sector, reduces the dependency on LPG as well as on petrol and diesel to that extent. So that is something that should continue to build momentum for all the CGD companies in the country.
Okay. Really appreciate your view and thank you so much for your time today, Prabal. It's been a wonderful conversation. Thanks once again. Viewers, with that, we're completely timed out on this edition of Market Edge. From Harsh, me and the team that put this show together, thanks so much for watching.